Good morning. We have another expert today at the New York studio, Mr. Barry Bannister. Actually, I personally had an interview with him a year ago. It was a kind of a joint interview conference hosted by the New York Foreign Press Center. I'm going to introduce him briefly. Mr. Bannister is a managing director and chief market strategist at Stifel. He's been recognized with a number of industry honors, including multiple best analyst rankings on Wall Street. He's been an analyst for more than 35 years. Mr. Bannister, you expected a 10% correction within a month or so at the end of last year. As a result, your prediction was right, although investors might have been disappointed a little bit. The market experienced a deep pullback from highs in January. What is your outlook for the New York Stock Exchange in the coming months? And what is the overall stock market expected to be by the end of this year?
Yes, right now there's several factors coming together. One is the Federal Reserve is pushing rates up. And the rate that matters for stocks is the real rate, the rate after inflation. And it's called the 10-year TIPS, or Treasury Inflation Protected Securities Yield. That's your real yield for 10 years. Using 36-month futures for federal rates, federal funds rate, that should already be at zero or slightly above. So we're seeing a very sharp rise in the TIPS. Now, as that yield rises from minus 1.1 at the end of last year to currently minus 0.45, your price earnings ratio for large cap growth stocks falls from 67 times to 47 times. That was the correction in the first quarter. The longer your horizon on earnings, the more your impact from higher real yields, because the money has a cost. And we see just a little bit more. So another pop up in the TIPS yield to zero and further decline for growth stock price earnings multiples. So that's the main basis for the call.
Okay, I see. The U.S. Consumer Price Index skyrocketed to 7.5% in January for the first time in 40 years. When do you think the high prices in the States will peak out?
Yeah, it's a great question. The problem we have right now with inflation is most of it has been goods. Okay, so these are things, hard goods, like dishwashers and televisions that you buy. And that was due to the lockdowns and people having a lot of cash thanks to fiscal policy, government payments. But it's starting to seep into services, which are 5 times larger than goods. So only 1% service inflation offsets any 5% decline in goods inflation. So as goods come back because of less demand, services can pick up. And so that recognition that having achieved its inflation goals pushes the Federal Reserve to exit. This was the 2018 exit. This was Janet Yellen. This was Jay Powell. This was Ben Bernanke. So, as these real yields rise, this price earnings ratio slides down for growth stocks, not so much for value stocks like financials and industrials. They don't have that long horizon. The growth stocks do, and that's what's happening in the market.
The Federal Reserve seems to move fast and last to increase the benchmark interest rate, which is the best weapon to take the fight to the inflation. How much do you think the Fed will raise the rate in the March meeting? And how many times do you believe the Fed will raise its key interest rate this year?
Yeah, the Fed is going to do not a half a point. That's not going to happen. But they'll do a quarter point each meeting. So they're going to do a quarter point March, May, and June. And then they have something called the SEP, Summary of Economic Projections, in June. It comes out again. And at that point, they can reassess. We'll have 6 months of data. We'll have a mid-year economy. I do expect what is going to happen is stocks will just waffle. They'll stay in a range. The best guess that we have on the market is that the thing that's not being accounted for in the market is China. China has tightened significantly, and you can see it in what's called the credit impulse, or the change in the growth rate of credit. It already went down as deeply as it ever has in 10, 12 years. And it's going to cause, I think, China's yields to continue to fall as they cut rates. And as the US yield rises, as the Federal Reserve is raising, China's easing, that forces the gap between the two, red minus blue, that has been advanced 7 months. That will cause the Chinese currency to weaken. So if you were to ask me what the next thing to happen is that by mid-year, China's currency will weaken. And that is important because China has a huge effect. As you can see here, China is 38% of all the world's money supply. So as the world money supply in dollar terms slows, this black line goes from 22% last March to 0 by this April. The dollar strengthened from minus 10, it's inverted, to plus 10. That tightens financial conditions and lowers the PE ratio of the market. So I think your market's going to have pressure on the price earnings ratio with this slowdown caused by China. Now, as for the Fed, I think they'll get to 1% quickly by the summer. But the calls for them to go to 1.5 or 1 3/4, I don't think that's going to happen. Not this year, maybe next year.
When do you expect the balance sheet reduction to begin then?
Very important question because, yes, we have too much reserves in the system. So the Federal Reserve through QE bought bonds from banks and non-banks, and they would credit either the reserve accounts at the banks, at the Fed, or they would credit accounts, checking accounts for sellers. So they created new money, and that money was liquidity, and it helped fuel this boom in money supply. And so that tightening of money supply, once again, as this money supply, which went from, back in 2018, it was at 0 growth. Global money went to 22% growth last March. It's now down to about 6, and we think it'll drop to about 0 again. Again, the Chinese yuan is extremely important. USD, CNY, the Chinese yuan. They are 38% of the world's supply of money. The United States is only 21% of the world's money supply. Europe is 19%. So China matters. As China realizes they've slowed their economy and has to ease dramatically and hits a growth break, so they're going to see this strengthening of the dollar due to the Chinese yuan going down. And again, that tightens up the Goldman Sachs U.S. Financial Conditions Index, the GS-US FCI on your Bloomberg. The year-to-year change of that was down 4. It will go to plus 1.5. Once again, the price earnings ratio of the market, which has driven the bull market since COVID, the black line, price earnings ratio, this multiple of valuation, has already started to peak. And so we think it goes down and then stays in this low 30s range. So that bull market in multiple has already peaked. And as so far as earnings go, this is your earnings for the Standard & Poor's 500. It took 3 years after the 2000 tech bubble recession to go above trend. It took 3 years after the financial crisis to go above trend. It went 1 year above trend this time.
It was too short.
Yeah. So we think it's going to slow down. As earnings slow down and multiples come down, your market goes flat within a range. The balance sheet is very important because it's a form of tightening. It's a great question. As the balance sheet tightens, you are going to see some, it's equivalent to a rate increase.
Do you think they'll start with MBS reduction, mortgage-backed securities?
Yes. I think it'll be a passive roll-off, meaning as there's prepayments due to higher interest rates, they'll let the mortgage backs disappear from the balance sheet because of prepayments on mortgages. As some of the treasury bills mature, they'll let them roll off. But the government deficit, the federal deficit, is going to be smaller in 22 than 2021. So it's not going to affect the government's financing because they're not going to have as much debt. Net, I think it's a non-issue for the most part 2022, but it's a bigger issue in 2023.
Do you think there is a possibility of an economic slowdown or stagflation in the States? Yes.
Well, yes. We've had a surge in goods. Okay. We've had a surge in goods. These would be, as I said, hard goods. Most of that demand is saturated. As the services pick up, I think they're going slowly. I think people are still nervous, and you're not seeing people return to the office, which affects the cities, the big cities, the city centers. You're not seeing people going to the dentist or the doctor as much because they're afraid of things like mass transit, air travel, and so on. So yeah, I think there'll be a hangover, a slowdown, but with higher inflation and a slowing growth, you get a little bit of what's called stagflation, stagnancy of growth with higher inflation, stagflation. And that really historically argues more for these defensive sectors. So when we look at the sector composition of the market, it divides between what you call value and growth. Value is mostly financials, healthcare, industrials, utilities, real estate, basic materials. Growth is mostly technology, consumer discretionary, which is Tesla and Amazon, and communications, things like Google, Alphabet. And what we find is that the net effect of that is that when you have the slowing growth, it pushes you more into a preference. Slowing growth with lower inflation pushes you into defensives like healthcare, utilities, consumer staples. So it's not going to be a strong growth economy. It's a great question you asked. It's not going to be a strong growth economy with high economic growth on the horizontal axis that pushes you into technology. And it's not going to be high economic growth that pushes you into cyclicals like industrials or financials. It'll be a more defensive market, I think, as you go into the second quarter.
As the yield curve is flattening, some people are starting to weigh more on the possibility of the reversal between the long-term and short-term government bond rates. Do you think it will be possible that long-term and short-term bond rates are reversed in the foreseeable future? If it becomes a reality, what will be the impact on the U.S. economy?
Right now, the difference between a 10-year Treasury and a 2-year Treasury is only 46 basis points.
That's right.
But the difference between a 10-year Treasury and a 3-month Treasury bill is 160 basis points. So that tells you that huge gap between 160 and 46 tells you the Federal Reserve is behind the curve. They're too late. They need to raise rates. So they'll definitely get to 1%. Okay, so they'll close that gap. 160 and 46. The question is whether the 46 goes to zero, meaning inversion. Short rates go above or at long-term rates. Will that short-term 2-year go up, causing the curve to flatten? I think it will. But the Fed won't be at a restrictive point that actually causes a recession scare until 2023, well into this process. And I do think that there's a little more upside due to the persistence of inflation in the 10-year yield. So the real and the nominal add together to give you this inflation component.
Many Korean investors have put their money into the U.S. technology stocks. What is your advice for people who still have growth stocks? What strategies should they come up with? There are so many factors that influence the stock market.
I don't think they'll get hit too hard. Most of the damage was already done. The Purchasing Manager Index, though, which is a Purchasing Manager Index for manufacturing, believe it or not, is a wonderful indicator for economic growth. As that slows down and goes to the left, it moves you away from technology and media and entertainment and so on. It moves you out of it into defensive. But because I think commodities are going to pull back, not to the old lows of 2020, but they'll come down within an upward wave. That keeps you. Stocks will beat commodities, and that will be pushing you more towards the growth. So net, I don't think there's a lot of downside, but I would say that if you are in the stock market, consider this. Let's go back to China, because China really matters for the global cyclical manufacturing sector, and it also impacts the US PMI. That if China's slowdown in credit, which is advanced 8 months, so it's already looking out to next summer, it's pushed out 8 months, says that the global PMI is going to fall pretty dramatically in the coming few months. If that happens, the global PMI comes down, the red line, the US PMI comes down. And why does that matter? If it drops suddenly from 61 a couple months ago to 53 by June, then you can see that the year-over-year change of that PMI will go from being up 45%, being down 15. So the S&P 500, which is this blue line, year-to-year change, goes to being down 5 against what? Sometime in the spring or early summer, against 41 to 4,300 a year ago. So what you're going to see is I think the market has some pressure on it. Some of your growth stocks that are high beta, they're going to actually wobble, go down a little bit. Their multiples will contract. So if you can find a cheap growth stock, good luck, then it'll be okay. Earnings growth offsetting a very low multiple already. But if they're a high multiple, which they are, most of them, I think technology stocks are going to have to see the price earnings multiple come down as the earnings go up. At best, you stay flat.
Then what industries or stocks are better to invest in then?
Well, if I'm right that this sudden drop, which is not appreciated by the market in this cyclical industry, so we're going to see a bigger drop than expected in the PMI manufacturing in the first to second quarter, that as it drops very dramatically, it's very much reminiscent of what happened in 2018 or 2015 when Powell and Yellen, respectively, were tightening. Okay, Yellen tightened, then Powell tightened. We had a big sell-off in 2018 in the fourth quarter, a 19.6% drop in the S&P 500. Janet Yellen had a similar drop back in the middle of the decade. So as that happens, I think you're going to see some scares among investors in cyclical stocks. Again, the S&P 500 has been wobbling. My comparison is going to be 5% down by this spring if the PMI drops. And this is what I'm comparing to a year ago, back in 2021 in the first half, roughly 3,700 to 4,300. I'd be cautious here. I think your growth stocks are going to get hit. And if that's the case, then you want to be in healthcare, particularly equipment and services and supplies.
Mostly defensives.
Yeah, defensives. And then staples,
Yeah,
food, beverage,
staples.
tobacco, food, beverage, and tobacco. Some of the utilities, depending on the yield. Remember, the 10-year yield has moved up to about 2%. If the Fed is exiting, if inflation is present, 2% is about the right level. So maybe utilities would be third on that list. The first would be healthcare, then staples, then utilities as defensives.
This is my last question. The possibility of Russia invading Ukraine are there, although it is not growing. If Russia invades Ukraine in the near future, how do you think it will affect the U.S. and the global economy?
I was on CNBC just a few days ago. The video's on YouTube. You can pull it up. I said that I did not think there would be an invasion. I think, Russia's economy is the size of Brazil. And we're all talking about Russia, which is what Vladimir Putin wants. He wants to be relevant. He wants to be the center of attention. He wants to be a superpower. He threatened to invasion to make it clear that Ukraine should not align itself with the EU or join NATO, which they cannot do anyway because they have no chance of joining NATO. There's zero chance that Ukraine could join NATO. Well, they have what's called a frozen conflict, and NATO never allows a member to join if they have a frozen conflict. So the eastern Ukraine is currently at war with Russian proxies, and southern Ukraine, Crimea, is annexed. So there's no way that NATO would allow a country in that has that kind of baggage, okay? So he made his point. I don't think there'll be a war. I think oil will drop. And what we did is we did a very interesting analysis here. We showed that when oil falls relative to gold, so this is the last 40 years, you see that since 1987, it stays in what's called a polynomial trend, 2 standard deviation high, 2 standard deviation low. When you get to the high, so Saddam invaded Kuwait, the technology bubble burst, the global financial crisis, Powell, fourth quarter 2018 over tightened. We are now at this high.
It's a kind of a ceiling, right?
Yeah, it's a ceiling. And as we hit this ceiling today, which we just did, I think we fall gold to oil. So that tends to drag down your cyclicals relative to defensives. And what are cyclicals and defensives? That drags down things like energy and banks and semiconductors relative to pharmaceuticals and healthcare and food. So what you want to do is you want to say, okay, that's going to go down. Cyclicals are going to go down. And the market might actually go down a little bit as that oil relative to gold has peaked. This is looking at the last 3 years here. Just like here, oil relative to gold coming down at the ceiling, S&P 500 with growth slowdown is not as attractive. But that said, I don't expect a crash. I don't expect a bear market. I don't expect a recession. I just think that your market is caught in a trading range, roughly bounded by 4,200 to about 4,600 in the coming 4, 5, 6 months. And we're near the top now, so I would be a little cautious because of the growth slowdown that's coming.
Thank you very much for your time today. I'm sure your views on the global economy and the US stock market are so helpful to our Korean investors. Stay safe. Thank you. Thank you so much, Mr. Bannister.
Thank you.